Everyone, this is Mike Wilkerson, founder of Stormwall Advisors. I wanted to come on and talk about something pretty important, and I think it may have relevance for pretty much everyone out there. And the question is your bank safe? We've had some shocking developments over the last few days. In fact, one of the most shocking since the global financial crisis 15 years ago. A very well-known bank, Silicon Valley Bank, which is the country's 16th largest with over 200 billion in assets, failed on Friday. Silicon Valley Bank is well known for its deep connections to the venture capital and tech world of Silicon Valley. They boast that some 44% of all venture-backed technology and healthcare IPOs bank with them, or at least they used to. And the question that the collapse of SVB is raising is the broader banking sector at risk of contagion? And we need to face this as a matter of urgency. SVB's demise came very quickly. On Sunday, the bank announced that it had lost $1.8 billion from the sale of available for sale investment securities. And its parent company announced that it was going to raise $2.25 billion to shore up the bank's capital. Now, rather than comforting investors and depositors, this surprising announcement spooked them and effectively caused a run on the bank. So within a few hours over the course of the next day, Thursday, depositors withdrew some $42 billion in cash, which was approximately 25% of total deposits, leaving the bank by the end of the day with a negative cash balance that approached nearly $1 billion. So unable to shore this shortfall up overnight by getting help from others, the initially illiquid and then insolvent bank failed. California's Commissioner of Financial Protection and Innovation took over the bank and appointed the FDIC as receiver early Friday morning, just yesterday. And I think it's very important to note that while the FDIC provides deposit insurance for accounts up to $250,000, this represents an estimated less than 10% of Silicon Valley Bank's total deposits. So the vast majority of Silicon Valley Bank's 175 billion deposits are uninsured. And according to the FDIC, uninsured depositors will receive a receivership certificate. I'm trying to read this and say it out loud for the remaining amount of their uninsured funds. So in other words, they're going to get a piece of paper from the newly formed bank that will be created to hold the assets and liabilities of the former SVB, and depositors will get basically a claim on future proceeds from asset sales, assuming that those asset sales are successful, but it doesn't mean that depositors will be repaid in full. Now, the big issue for Silicon Valley Bank was its assets were heavily weighted towards investment portfolio securities. So specifically, some 57% of Silicon Valley Bank's assets were marketable securities, mostly U.S. Treasuries and mortgage-backed securities. Well, with the rapid rise of interest rates over the past year, the market value of these bonds has fallen substantially. Now, that fact wouldn't really matter if a bank is able to hold those bonds until they mature, at which point, assuming the underlying entity, the U.S. government or otherwise, is still able to pay, they will be repaid at par. So there's no impairment if they can hold these bonds or notes or bills or otherwise to maturity. However, if the bank is suddenly forced to sell them in order to generate liquidity, that is to meet depositors' demands for cash withdrawals, then the bank is forced to sell now and therefore at a loss in a situation like this. So you get into this vicious circle where unplanned asset sales generate losses, losses weaken the bank's financial position, depositors get nervous and demand their money, which in turn requires more assets to be sold, thereby stimulating further losses, and down we go in a spiraling descent that accelerates very, very quickly. In the case of Silicon Valley Bank, this happened in a matter of hours. Now, typically, illiquidity, not insolvency, is what causes banks to fail, and that was certainly true for Silicon Valley Bank. The question now is, and the point of this message is, how many other U.S. banks are similarly exposed to this type of liquidity risk? Analysts are working overtime to review the data on U.S. banks to see which others may be in a similar position to Silicon Valley Bank. While SVB had the highest ratio of securities to assets, several other regional banks have more than a third of their assets in similar categories. Should their depositors get nervous, bank runs could occur elsewhere, and this could spread in a form of bank contagion in the coming days. We saw towards the end of the week that the collapse of SVB sent shockwaves through banking and financial markets. The Nasdaq Bank Index was down nearly 5% just on Friday alone. The Dow for the weekend is down 11%. And because of its concentration in the tech sector, crypto looks like it will be particularly impacted. SVB was a preferred bank for the industry, and two of the largest crypto exchanges, Coinbase and Binance, just earlier today suspended sale or convertibility of USDC, the stable coin that's pegged 1-to-1 to the US dollar. Well, as a result, USDC depegged, and early Saturday morning, its value was trading at 90 cents on the dollar, which is quite a problem for a product that is, as the name implies, supposed to be stable and be able to be pegged. The problem is that Coinbase's parent Circle confirmed on Saturday that it had 3.3 billion of reserves at SVB that it had tried but had not been able to get out of the bank on Thursday. So with a total of around $41 billion of USDC in circulation, that 10% hit wipes off about $4 billion in market value unrealized. Now, let's hope that things stabilize here. But the point is the situation represents a new challenge to the viability of crypto and the stablecoin model, which is already under pressure from all sides. So I think as a takeaway, viewers should take this opportunity to consider whether your banks are safe and sound and whether they may face unrecognized risks. This is not a message to scare anyone at all, but it's to say you should be prudent and should be aware of where you bank, how you bank, what risks may be hidden beneath the surface of your relationships with banks and financial institutions. The reality is that banking crises are often driven by matters more about human nature and market psychology as much as they are about asset and liability mismatches at the banks themselves. Now, if investors and depositors regain confidence in the coming days that the issues here at Silicon Valley Bank were bank specific just to this one institution, then the storm will pass. However, as we've learned time and time again, fear is this highly contagious pathogen. And to the extent that a broader panic ensues, we may be looking at a banking and financial markets crisis of a frightening magnitude. So this is one where I think it's important, it's probably urgent, that you keep a close eye on this one over the coming days as we continue to watch how this situation plays out, and especially as we move into Monday with the reopening of banks and some of these related financial markets. If you've enjoyed this, if you've got something out of it, please do like it, share it. This is an important message. I'd like to get this one around this weekend over the next few days as much as possible, and subscribe to my channel here on YouTube. And you can learn more about this and other situations similar at stormwall.com. And if you want to learn more about Stormwall Advisors, check that out as well at stormwalladvisors.com. Thanks, everyone, and we'll see you next time.